Let's start the conversation with Shreyas this morning. Shreyas Devalkar, Head of Equity at Axis AMC, joining in. Shreyas, a pleasure as always to speak with you on the channel. Thank you so much for your time this morning. Do you reckon that we'll get over these Q3 blues anytime soon? Let me start with a simple and basic question.
See, as far as earnings are concerned, I don't think it is only about Q3. So the indications were there in Q1, Q2 results as well. Probably for some reasons, market at that point in time ignored. So markets tried to focus it even from September. So if you say market started correcting from September. As far as these earnings are concerned, the top line growth slowdown was observed even in last year. It's just that the margins were really good in some of the sectors, and that has led to good bottom line growth. But after Q2, Q3 especially, that margin lever also actually tried to reverse in some cases. And that's where these earning growth blues probably are hurting the market more now versus earlier.
Shreyas, good morning. Now, the opinion is divided right down the middle, right? This is Neeraj here, of course. The opinion is divided right down the middle about whether these valuations prompt people to be constructive on India, or should lower growth entail India trading below average valuations as well? And I'm only talking large caps. I mean, the SMIDs are, of course, still higher. Where do you stand on this argument?
It's a very interesting point, and there are multiple angles to it, and that's why I would like to get into the details of it, because when we say large cap, and if I go by definition, it is top 100 stocks, right? You will notice that actually in this fall, top 50 stocks, that is Nifty, has fallen lesser than next 50. So the story is different in Nifty 50, the story is different in Nifty next 50, which is also top 100 on large cap, and that has fallen equivalent to mid and small. So to put it in a different way, when it comes to the valuation, the market has divided into, or got divided by September, market got divided into two halves. First half was relatively low growth companies, okay, and those low growth companies are utilities or they were in lenders, banking, financial, insurance, FMCG, consumer durable, auto, IT, pharma, metal mining, oil and gas, entire pack, agri, infra, cement. Actually, these sectors didn't get re-rated the way other part of the market got re-rated. So I would call it as a relatively low growth and relatively lesser re-rated, or actually some of them got de-rated. Coincidentally, the weightages of this is more in the large cap, that is Nifty 50. If you take Nifty, if you take BSE 100, then the weightage of this is somewhere around 70%. And this segment of the market is actually relatively derated because, or not got much rated, because there is lack of growth, and that was visible for last multiple months, or actually multiple years. So actually this market was about stock picking for last 2-3 years. Now actually it is getting into this balance of carrying low growth risk with low valuation, or carrying high valuation risk with high growth. So which are these sectors which has shown high growth and are promising, which has shown promise of showing high growth, is power, capital goods, electronic manufacturing services, EV, import substitution stories, platforms like quick commerce, fintech, capital marketplace, travel tourism on the consumption side, retail industry, part of chemical, hospitals, and real estate. So these are the high growth segment, and market has identified them. So that's why I call it out that this market is actually the stock pickers market is behind. Market has picked stocks for you in last 2-3 years by classifying them as a high growth but low, but with very high valuation, and low growth with derated or not much derated.
Got it.
So as a portfolio manager, we need to balance these two rather than talking about large versus mid and small. I agree with the fact that yes, coincidentally, most of these derated are not much rated are in the large cap versus mid and small.
That's the point. And the other point, Shreyas, sorry. So, let me try and take an example of some of the pockets, right? I mean, power, for example, let's say and include transformer companies. And I'm saying that as an example because just speaking to one company half an hour before you joined us, right? And that company, I mean, you can't talk about names, but I'm just using that as an example, that Transformers and Rectifiers says that we will continue to grow at the pace that we are. But Shreyas, my question is, with those numbers, the stock, after having corrected, is trading at, let's say, circa 25 times FY27. Now, would you call 25 times under the current context 2 years out expensive, or do you believe businesses which are trading at such valuations or higher but promising very high growth are worth buying into? I'm just using this as an example, but a broad brush essentially. That's the question.
Sure. Yeah. So good that you used or pose your question with an example. But my answer is broad-based. So that is not only about transformer. That happens to your electronic manufacturing services sector, also import substitution stories as well, travel tourism as well, and multiple such stories. Now that's where I am highlighting the point that some of this re-rating, which is some of these sectors which used to get traded at 10, 15, 20 P, with growth, low debt, we said that yes, as a market, everyone said that now with lower debt, corporate India has less debt, etc., etc. Now they, instead of 15p, they deserve 20, then 25, then 30, and 35, and so on. And then what is that limit where you say enough is enough? Probably market reached that limit by September, and then now it is reversing from those. And that's where, in some cases, I would argue that yes, the market is getting to the level that one can look at them constructively, because valuations are, if not attractive or mouth-watering, they are reasonable. That is probably the word I was used, rather than calling out them attractive as such. But then those pockets are far and few, and that's where, when anyone is taking such a call that yes, whether I should buy blanket all the four stocks which are fallen by 30%, then to me that that conclusion is not true for all of them which has fallen by 30%. So expecting that all the stocks which has come down from 45p to 35p to go back to 45 and make money may not be right. But yes, some of them, if they don't go back to say 45, but at the current growth rate, they can give us return. And that's where at the overall level, probably these pockets where you can call out that, yes, now the valuations are good. Those are emerging, but they are still not to the extent one can call out that there can be a broad-based rally as such.
You know, I'm just wondering, Shreyas, what you're making of NBFCs post the relief that has come from the RBI circular. And do you think it is a very fundamental shift in how you would view some of these companies, or is it more in the nature of a temporary relief?
See, as far as NBFCs are concerned, for some of these steps which regulators took probably in 2023, somewhere close to November. So partly it is a reversal of that, or part reversal of those steps. And it is a really welcome move. Probably it leads to better liquidity for the sector and more lending in that scenario. But if you just, instead of talking about only about what the steps taken recently, if you say the multiple steps taken, right, from liquidity improvement to all these steps as far as the risk weightages are concerned, overall the story is yes, with the proactive steps we actually the regulator took 1.5 years ago. And probably that was a really great step to take at that point in time. And with that step, probably we might have averted a problem in the retail credit, right? And now with that, at least in last 1 quarter or so, what we have observed in the listed companies result, at least, that there is no, the credit quality is not worsening, at least, especially. And to that extent, since this trend, if it is continued, and then the regulator also have taken multiple steps. So with that, I think this sector can be good in that context. And other point which I also highlighted, that lenders actually as a pack, they have got derated or not much re-rated versus their valuation compared to the pre-COVID level. So generally, what I tend to do is compare the valuation pre-COVID versus now, and check whether there is a re-rating, de-rating, and if there is a re-rating, whether it is 30% higher or it is a 50% or is 2x higher. So just to take a case of IT sector. Now, IT sector is probably 30% higher. They should trade at 18 types, and now they are at 25, 26 type, right? So whether you are trading at 30% higher or whether companies are trading at 50%, 100%, 200% higher than the pre-COVID, the companies which are still trading at 100%, 200% higher compared to the pre-COVID, we need to really check and recheck whether that is justified or not.
Okay. I'm just wondering if you have a take on, and I know it's specific, but on cables and wires after the kind of turbulence we've seen with Ultratech announcing its entry, not done great shakes for Ultratech either, frankly, as far as the stock is concerned. But any take on this kind of expansion and the space?
This space broadly is around the 70,000 crore industry as such, doing well with the real estate sector doing well and construction activities, including data center, etc., etc. So definitely this pack of cable and wires, and including to some extent conductors, where this entire industry is a proxy to a power growth story in India. So that space remains attractive. It has always remained attractive for the investors. Always in any case, so it's not only about this industry. In any case, obviously, whenever there is an entry of new player or so, then there is always cautiousness. So you have seen that in the paint sector earlier and so on. So whenever there is an entry of new player, then definitely all you have to rethink about how the industry will evolve. As far as industry is concerned, definitely there is a growth story. But as far as industry dynamics are concerned, that is competitive dynamics. That's how will shape the stock market return for us from here on.
Absolutely. Thank you so much for that, Shreyas. Speaking on some of the most current topics this morning as far as the market is concerned.